All right, you guys, welcome. Doug McKay, anti-wallstreetguy.com on the 7th of October, 2011. We'll finish up with the S&P tonight, but let's start out with a chart of GLD. And we put a post out on the 4th, a still chart, identifying these upside gaps here. The overall trend still remains down for gold. We're below the 50-day moving average. We could see a bounce to fill these upside gaps, but before we would do that, if we were to pull the trigger, we'd want to see a close above this channel. More specifically, a close above the highs that we put in on Monday, and that high was 161.56. But as it stands right now, at some point I think we're going to fill these upside gaps and come back up to the underbelly of this blue line here, which is the 50-day moving average, somewhere around the 170 range. However, this to me looks more like a bear flag, some type of pennant tight formation. And if we were to take out these lows that we put in on Tuesday of 155.27, it looks like we're going lower in gold, in GLD. So be careful if you're playing gold to the long side, because we could be going lower here. Again, we'll assess the situation next week, but the overall trend right now in GLD, especially with this pattern this week, is down. All right, let's take a look at the Qs. And one of the reasons I want to look at the Qs is because we really never took out the lows from August. If we were to put in a support line here, you can see that on the Tuesday lows, we never broke. There was never any type of shakeout. We are also above the 50-day moving average. Certainly we have overhead supply here. You could make a case for this being kind of a head and shoulders pattern, left shoulder, head, right shoulder. We can also make a case that the neckline is held, which is also this double bottom here. So if we were to get long next week in the managed accounts, we would certainly pull up the Qs and take a look at that. Now let's finish up with the S&P 500 and kind of looking at this black and white in a one-word answer. As of the close today on the 7th of October 2011, what is the overall trend? The overall trend is short. It's still down. We're still below this blue line, which is the 50-day moving average. We are below the 30-day moving average. Yesterday we were above the 20. We just closed a little bit below it today, and we are also below the downward sloping trend line. Now, an arrow in the quiver for the bulls this week is the key reversal that we had on Tuesday. Big down day Monday, follow through shakeout day on Tuesday, and then off to the races late into Tuesday, big finish towards the close. Obviously a nice day on Wednesday and Thursday, a little bit of a pullback today. This did happen, however, on decreasing volume, but this was a key reversal. It's just too early to tell whether or not that this is the low and this is going to be the bull move to take us in to the end of the year. Based on what we were seeing technically for several weeks, is this is a fourth wave, a fifth wave down, which actually broke support since we spoke last. This broke support on Monday, thinking that we're going to go somewhere between 1050 to 1,000 to the downside to complete that fifth wave. Maybe a shakeout there, and then a year-end rally with a blast maybe up to 1250 or higher. It's possible that this move year-end rally is starting, but it's too early to tell. What we did do in the managed accounts, if you recall last week, we mentioned that we were playing both sides because we were still in this channel. We were long J&J, we were long the utilities XLU, but our biggest position was cash and then short the S&P. We did almost in all the accounts in the morning when the SH was working and the S&P was down, exit the SH. You have some type of feeling when we have two down days like that it's going to reverse. We started to see that towards the close. We did also exit our long positions as well, though, XLU, J&J. So the way it stands right now, as of the close on Tuesday, even prior to the close, for the most part, about 99% of us are 100% in cash. as of the morning on the West Coast on Tuesday. The reason for that is because we thought this was a little overdone to the downside. And then also we had the big jobs number out on Friday, so we thought it was best just to sit in cash. We will stay in cash until we get a buy signal. If we do not get a buy signal, we will look to the short side again with a break of 1100 on the S&P. Now let's take a couple scenarios. That's one of them. In other words, let's say this continues to break down. We would look to short, meaning go long the SH inverse ETF if we were to break 1100. If we break out and we get above the downward sloping trend line, if we get above the 30, we get above the 50-day moving average, and then we have even more follow through where we add to a long position above, let's say 1200, 1210, 1218 in that area, where would we exit? If it all fell apart, we would definitely exit if we broke 1100. 1100 as it stands right now is a key area of support. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com. Be careful if you've got some bonds here. You may want to hedge them with the TBT. Pull up that chart. As of the close on the 7th of October 2011, the overall trend is short. That could change next week. We'll see you next week on the blog. Thanks.